This looks like a great setup in that room.
Mark.
Oh, hi,
Hello,
Mark.
how are you? Oh, there I am. Now I can see myself on the screen behind you. Kind of eerie. Anyway, I want to welcome everybody and thank Marty for this opportunity to pinch hit and step in for George. Uh, Funny thing is, I was really looking forward to hearing George speak. Back in my days when I used to raise capital for funds, um, one of the things I would do, he'd be one of the people I would call on with some regularity. So I was looking forward to hearing his take and how things have changed in the capital raising market. But today I'm pinch hitting for him, and I had the pleasure of having Suzanne Murphy, a managing director of Lampe Conway, Ellen Snibbe Baker. She's a partner at Baker Aurora. And in full transparency, Ellen clears her deals through Pickwick Capital, which is the firm I'm affiliated with. So we sometimes get together and work on things. Alex Silver, who is a general partner with Ananym Capital Management. Alex, did I say that right?
You did. Very impressive.
Terrific. And they probably did a prep call with George to get ready for this. So all that is out the windows, guys. Whatever you spoke about, I have no idea. But from my point of view, we're going to be speaking about a bunch of topics related to manager selection, including, investor appetite, perspectives of domestic and international investors, relationships between investors and managers, ESG, fiduciary rule, emerging managers. Obviously, the whole program is focused on emerging managers and the role and value of placement agents and finders, due diligence, etc. My name is Mark Heil. I'll be moderating this panel. I'm managing director with Pickwick Capital Partners, a FINRA registered advisor to the middle market companies and alternative asset funds, providing specialized strategic and transactional services. We provide a full range of investment banking and fund placement advisory services for public and privately held companies. For the next hour or so, we're going to be having a conversation. I like to run these as conversations as opposed to me just asking questions and going down the line getting answers. I'd rather have our panelists go back and forth with each other and have discussions um, and I want to invite everybody in the audience to be part of this. I'm going to ask the audience to do us a favor. Time is very precious to us up here. We only have 45 or 50 minutes. We have three panelists. So you ask a question, keep it, get to the point of your question quickly. And if they need some more context, they'll ask you. Finally, I always do this for my own protection as well as my panelists. A little disclaimer. Information presented here is for educational purposes and is not intended as and may not be relied upon as tax, legal, or investment or other advice. To the extent myself or any of the panelists expresses an opinion as part of this discussions, they are personal opinions and not necessarily the opinions of their firms. So with that, I would like to maybe get us started and learn who our panelists are. Suzanne, I hope you don't mind. I'd like you to lead off and talk about yourself and Lampe a little bit.
Sure. It's Lampe, by the way.
Lampe, my apologies.
That's
See, if
okay.
we'd had a prep call, I would have known that.
So I'm Suzanne Murphy. I'm a managing director at Lampe Conway, which is a relaunch of a fund that we ran from 1999 to 2013, end of 2013, in the lower middle market restructuring distress space. We look at companies that are sub $1 billion in enterprise value, cap stacks that are generally sub 500 million. We look to enter through public securities. So we're really looking for the fulcrum. 50% of the book is toehold positions where we take 50 to 100 basis point positions. We get to know the company, we get to know the business. Sometimes we buy something at 70, gets pulled to par. Sometimes we buy something at 70 and we decide it's a melting ice cube and we trade out. And then sometimes what we're looking for in the other 50% of the book is for that bond at 70 to go to 30. And one of the reasons for the toehold book is so that the street knows that we're involved in these names, so that when there's a covenant breach or a problem, and T. Rowe Price has to puke their position, and the last mark is 60 and the next trade is 30, people know we're interested and we get that look. The other side of what I do is I have my own family office. We work with an outsourced CIO called ICG Advisors out of LA. We are strictly alternative focused. So people always say, well, what do you invest in? All funds, so we don't do directs, and pretty much anything but traditional fixed income or long only.
Excellent. Ellen, why don't you do a little introduction of yourself?
Hi, I'm Ellen Baker, and I'm also with Pickwick. I have my own company called Baker Aurora. We consult to family offices and introduce them to alternative investments. And what I mean by that is primarily venture capital, private equity, little nuggets that you can't find on the internet, you wouldn't get from your broker at Morgan Stanley or Goldman or whatever. And I was particularly attracted to this topic because at Pickwick, I consulted with one of my colleagues about emerging managers and, something special. And there was one that jumped out at me called InvestX. And what they do is, for example, if you were in Silicon Valley and you got laid off and you had SpaceX, for example, and you realized you had a chunk of it, but it wasn't a large lot, you could sell it to this company at a discount and have some liquidity. And this is available for people to buy into something like this so that everything in this portfolio is not seed, it's not emerging, it's pre-IPO and unicorn. And I think of this as a type of emerging manager that I'd put my own money in, and that is something different, something special, something I could go to my family offices that I deal with and say, hey, look, if you buy venture capital, maybe 1 in 20, maybe 1 in 30 goes to the moon. If you buy, the next growing kind of company, maybe you have, good luck. But if you buy a pre-IPO or a unicorn, you're pretty sure you're going to maybe get 2, maybe 2.5 on your money. So if in a portfolio where they have only this kind of investment, I'm thinking this is a pretty good example of an emerging manager that I would like to show to my clients and prospects.
Fantastic. Thank you, Ellen. Alex, why don't you take a few minutes and just talk about yourself and your firm?
Sure. My name is Alex Silver. I'm the CIO and co-founder of Ananym Capital Management. We are a small and mid-cap activist firm that is launching mid-year. We are backed by Tiger Management as the first managers backed in the activist investor space, as well as a large asset management firm out of Canada, now called Corient, used to be CI Financial. My background is pretty much spent my career on the street. Started at Lazard Frere, then I worked at the Soros organization in the private equity group, went to business school at HBS, joined a Soros spinout, which was a traditional long-short firm called Karsh Capital. And then about 17 years ago, joined a firm called P2 Capital at its formation as a partner and member of the investment committee. And what we did there was a form of activism that was constructivism, suggestivism, you pick whichever ism you want, in which we got highly involved with the firms, companies in the US markets, as I said, small and mid-cap, and worked to affect change operationally, financially, and moving things into the private markets when appropriate. Ananym Capital is also co-founded by Charlie Penner, who is the head of engagement. Charlie spent his career originally across some law firms, including Schulte Roth, then was at JANA for almost 17 years, where he joined as GC and became a member of the investment committee, and then ran all of activism at Engine No. 1. You will probably know Charlie best for the ExxonMobil campaign, which he won the largest proxy battle by market cap of all time, owning less than 2 basis points of stock. So what we do is a bit differentiated than other firms in our space. We focus on 1 to 7 billion in market cap. In the US, we run a highly concentrated portfolio that is long biased, though it is hedged. And I believe in hedging proactively. And between Charlie and I, you have 40 plus years using every single tool in activism to drive positive outcomes for shareholders. That includes behind the scenes, public, as well as moving things into the private markets, meaning private equity, because I've spent my time in both worlds. We will launch mid-year, currently are raising our founders class. We think the mid-cap space is particularly attractive. It's performed, or it's relatively underperformed large caps by an enormous amount. While I was wondering if I'd get into New York tonight, or back to New York, I should say, but last night, because of the weather, I was looking at some data that show you'd have to go back to 1998 to find a larger gap between earnings multiples between large and small cap. And that doesn't mean small cap's going to go to large cap. Maybe large cap comes down, but you're fishing in a pretty deep pond when it comes to things that have not performed. Lots of opportunities. At my former firm, 45% of my exits were through some form of strategic transaction, not to mention the normalization of interest rates and how they affect smaller cap companies. So we will be up and running, as I said, mid-year, based in New York, and excited to tell you about our strategy and opportunity.
So I just want to be clear, you invest directly into public stocks, or could you just clarify what you invest into?
Oh, sure. We focus on $1 to $7 billion market cap public securities based here in the United States. We have the ability to cross over into the public markets. An investor at time of subscription could be part of a side pocket. It's entirely optional. If we do that and we do a take private, it's in collaboration with a top tier private equity partner. You have the ability to participate in that transaction and add additional capital, but everything starts in the public markets with us.
Gotcha. Okay. Just want to be very clear on what your strategy was and how you were executing that. So let me ask everybody, since this is about emerging managers, and it's always interesting to me when you talk about that topic, what is an emerging manager? Alex, I'll start with you. Let you answer that from your perspective, because some of this answer is sort of like if you met a family office, you've met one family office, you met one investor, they have a very different definition of emerging manager from the next investor.
Yeah, so, I mean, I look at an emerging manager as a new fund / new product, not necessarily a brand new manager. So if you look at, for example, my partner and I, we have 40 plus years experience, and I would genuinely argue experience is a positive, but a lot of runway. So I look as an emerging manager as one launching a new fund, a new firm, or potentially a new product area. And that's how we think of ourselves. It's fascinating in the dynamic in which you've seen family offices tend to be an area that likes emerging managers. They're often quicker to pick up on the opportunities that you can see versus larger endowments, slower moving entities. So that's how I would define it. And for us, it's really about finding the right LPs who like our strategy, the ability to create meaningful alpha that is sustainable, and then really like the opportunity of the co-invests in the public and private world as we generate them.
Suzanne, same question over to you. Just, how would you define an emerging manager?
It's a tough question, right? Because we are looked at, Lampe Conway, the new fund that we're launching, as an emerging manager, even though it's the same team. The two managing principals have been together 35 years. The rest of the team has been with us for at least 20. They kept the team together this entire time. So that's one example. Another example is what you're doing, having spun out, having a lot of experience. One of the things I will say, and I tell managers this all the time, what the SEC makes you put on the cover of your book, past performance is not a good predictor of future results. It's probably only true in our business, but it's very true. So one of the things that I focus on with my investor hat on when I'm talking to an emerging manager is how they describe their process, whether or not I feel that process is repeatable and sustainable, and what the opportunity set is in the asset class. But some people define it as less than a certain AUM. I think it's all over the board.
It surely is. If you go to a pension fund, they oftentimes will tell you it's any fund under $2 billion, right?
Exactly.
So, and then you have all these emerging managers out there saying, but I'm $100 million fund. How am I ever going to get their attention? So you have to really know your audience, know your targets. And Ellen, that's where I really want to come into you. When a family office looks at the potential of adding an emerging manager, why would they want to make that consideration? Why would they want to go to an emerging manager as opposed to a tried and true, a blue chipper?
I believe that they are looking for yield. They've already gotten the blue chip stuff from Goldman Sachs or Morgan or wherever. And they're looking for little nuggets that are going to give them that spurt. And I think that's why they look to emerging managers. And that's why I spoke about this one in particular, just something a little different. There are people that seek out venture capital, and I like venture capital a lot, but the odds are good that you'll find maybe 2 out of a portfolio, say 30, that maybe do something extraordinary. So to find something that is closer to an exit strategy with a bump into a pre-IPO unicorn, that might be something that is very attractive for an earlier exit, and something that looks like you're going to get a nice bump. It's still, a little bit, difficult and interesting, but that's why I look to a nugget, an emerging manager that I think is going to be worthwhile for my potential portfolio of people.
I'm just going to add to that. I think one of the things that is very attractive about emerging managers across the board is, and again, everybody has different risk parameters and levels of tolerance for risk. But when a guy gets to be blue chip, he's got a lot more of his own money in the fund, takes less risk, and you don't get the performance reverts to the mean. So
I was going to say very similar profile is if you actually do a study, emerging managers are the place to get the highest performance on a risk adjusted basis. And as to not only do they have more money in the fund, the larger you get, you become the market, right? It's very hard to outperform when, you can look at what's happened in the private equity industry. The mega funds returns have compressed because it's very hard to outperform when you amass such assets.
Well, it's funny. It's one of the reasons why we like the lower middle market space and credit so much, because not this year at iConnections, last year, there was a panel with Mark Lazary, Josh Friedman from Canyon, John Zito from Apollo, and Arrighetti from Ares. And they're all sitting up here like we are. And they're like, listen, deals, guys, we're in a food fight for the same deals, and we're going to overpay and we're going to underperform.
Now, I want to just toss out a little different scenario. I have a fund. It's an AI fund. It's called Einstein. How much is that worth to you? Apparently I'm missing. So I've got a red hot area. We're experts in this, and we've been at this for a few years. We've got a great name for our fund called Einstein. It's an AI. Alex, give me your thoughts.
Mark, is it an AI private equity fund, an AI venture capital fund, or an AI trading fund?
Well, it's a private equity fund, but we're going to dip down and we're going to do, obviously growth equity. We're going to do, maybe dip down to venture. So how would you respond to something like that? What are your, how would you evaluate that? How would you look at it?
I mean, to be direct, I'd need to know a lot more.
Yeah,
you couldn't tell me the value of my fund or any of my co-panelists simply by our name and one line. So what do you invest in? What is the profile of it? How much capital have you put to work? What are the profile of the underlying investments? Where are they in their growth curve? What is their market opportunity? Who are the teams? So I would just answer it with a whole series of questions as opposed to
Mark is sounding a lot like a pre-2008 hedge fund, if you ask me. All right.
And it's a crowded space, so there's a lot of people to look at.
Without question, that's really what I was looking for. How would you look at it? How would you evaluate? What questions would you be asking? And that's exactly where I wanted to get to, because I think it's important for people to hear those, even though it seems like everyday work to us and everyday things. For some people, it's new to them. Ellen, for the last 10 years, the market's been characterized by low volatility, slow growth, low inflation, low interest rates, and today things are a little bit different, right?
Right.
So how is this going to change the market? What's going on now? How is the market changing in response to the changing economic, and how does that impact emerging managers looking for capital?
Well, that's a tough question. But I think the interest rates that have gone up so dramatically recently have affected my business in the sense that a lot of people have just put money on the side looking for nuggets, but are very cautious because of the interest rates. And also the thought that the interest rates are determined to go down in about 6 months, let's say. And
Well, I think Powell disabused the market of that last week.
yeah. I'm sorry, what?
I said, I think Powell disabused the market of rates going down.
Oh, okay.
If you don't mind, do you mind if I add
No,
something?
please.
So I think one thing to think about interest rates as it particularly impacts, at least I can opine on what we do, which is we think it's the opportunity within the small and mid cap space. So if you look throughout history, the abnormal period has been the last 20-ish years to have such suppressed interest rates or have such low ones. During that period of time, if you think and believe that people respond to incentives, which they do, companies, small and large, had the incentives to grow at all costs because you could finance your way out of anything. You would also always buy back your stock because the after-tax cost of debt was zero. So part of the reason we're focused on the mid-cap space is, as Suzanne said, number one, everybody else is looking elsewhere. They've narrowed on 4 stocks that drive the market that are conceptually high growth, and they're huge and they've compounded. I agree with that. There's less competition in this mid-cap space because of the underperformance. I think a lot of it because of the interest rate regime, which has changed wherever it lands, as long as it's not back zero, whether it's 4, 3, 4, 5. And more importantly, if you do what I do, which is, activism with an operational bent, people often think of those who own the assets as being the real beneficiary, but they also forget that you have a whole generation of operators and managers who grew up in this environment. And now they have to earn a cost of capital. So we look at it, actually, the interest rate regime, while being a tailwind or a headwind for a lot of things, is a real tailwind for mid-cap activism. But it obviously is also a headwind when it comes to a number of ways in which a meaningful rate cycle actually spreads throughout the economy on a compounding basis.
We agree with that wholeheartedly. And if you think about also the private equity sponsors who have levered these companies up, and the operators are left with debt that they didn't want in the first place, but now they can't cover. So those balance sheets are going to need to be restructured.
Yep.
Without question. And one of the things I think that's, in restructuring it is who are the capital sources available to do the restructuring of those debts? If we listen to this, the talk that was given this morning on the economic side, it sounds like the banks are certainly facing some difficulty, and they probably wouldn't be the ones to do it anyway. So who's going to step in and fill that void?
I think we are.
Yeah,
that's the hope.
Yeah, I think, we play at different points within the investment cycle, but I believe, I'm working with companies that typically are not distressed, have a value/GARP basis, generate free cash flow, and have a good enough balance sheet, but may not be the right balance sheet for the public markets. Not so long ago, certain industries, they encourage companies to run at 6 times debt to EBITDA. Now, 2 times is the new 6, and who knows where that goes. So I think within there will be companies that may or may not be good public companies. I think as you think of what Suzanne had alluded to, there will definitely be a solution provider. But also, one of the things that I always find interesting is never underestimate the ability when people have duration to keep things going until things just get a little bit better, because there's a whole system based on that. So I'm not a doomsday individual, but very simply speaking, you had current, you were swimming with the current, and now you're swimming against it. And that is going to cause all sorts of downstream effects.
Yeah,
I see a gentleman in the first row there.
I'm sensing that the 2 young ladies are more relevant to the question, but please answer it. I'm curious to know how you, Ellen, get compensated for what you do, because it sounds like you might be representing a group of capital sources, family offices in some capacity. I think I understand how she works, but there are opportunities out there that fall below the radar. For instance, there was a roll-up I was trying to do, and I'll give you an example of part of the situation. The equity market was at the 50 million and above level on this. It was in the fiber optics industry. I wanted to go below that. Now, when you're dealing with a $10 million company, if you can put 5 of those together, you got a $50 million company. And if I can do a stock swap, it costs me nothing. Because now I've improved the valuation of all 5 companies that I put in to get the 50 million at 10 million apiece. The problem you run into, and that's where you go below the radar screen and you're not bidding against everybody in creation. And you can make money on that. Where's the difficulty? Getting those 5 players to understand what you just said, or what I just said, and getting them to give up the equity in their company, continuing managing their company, putting an investment holding company over them. Because now you've eliminated all those costs. You've consolidated the costs in one group. Okay, and you can go out and get money now. You're now competing against the $50 million player. And you can take that to 100 million, 100 million plus. Now there are some items. Well, the point is, I'm saying that one, I wanted to find out how you work in terms of your investors, and there are opportunities out there that are below the radar screen. So how would you address that, given the problems that you have to deal with below the certain level, dollar level, the lack of sophistication?
It varies. It totally varies. There's sometimes I'm on a retainer. There's sometimes I work on a success fee. It varies all over the map. I don't have an enormous group of investors that I work with. So it's really a tight-knit group. Everything is created depending on the need.
I've always been internal. So I work for one fund.
Okay. Do you invest in individual transactions rather than an individual transaction as opposed to
in our
fund?
In our family office? No.
So you're not a direct investor?
No.
Got it. Okay.
I mean, our fund is, but my family office is not.
Understood. No. Yeah. I have some more questions.
We just decided it's something we're not good at.
Well, totally understood. Most family offices should not be doing direct investment because they don't have the staffing for it.
I'd rather pick a really good jockey.
So smart. Absolutely. Yeah. So, Mark, actually, I have a question for Alex. So I just want to. So what I find interesting about what Alex is doing is as an activist is that being a value investor for the last almost 20 years probably has been the worst strategy you could employ. Would everybody agree? I mean, it's just been terrible because, as you just said, you could always find liquidity and borrow for another day, right? And you have to assume that with Powell, maybe he's going to toe the line and keep rates high. He's not going to cut it dramatically because even the reading on interest rates today was pretty hot, right? So I think that leaves a 20-year queue of companies that can get fixed. I don't know, what's your perspective? Maybe you all can talk about, your perspective on value. I mean, there used to be so many value guys out on Wall Street, and that whole space has just died. Even the activists, there's some great activist investors, and even they've taken post 2012, let's say, they haven't done that great. So Ellen, why don't you start, since you've been in the business for a long time, and then we can get to Alex's answer and Suzanne's answer as well. Suzanne,
can you redirect the question?
The question is there a 20-year queue of value investing to be done because people have been able to borrow and extend and pretend for 20 years?
I think I'll ask Alex.
Okay, Alex, why don't you start? No, because I'm asking your opinion on value. I'm asking your opinion on value, right? So.
Oh, I'm happy to jump in. So I don't know if there's a 20-year queue, Marty, because you have an entire ecosystem, especially in the private world, that is based on all these companies that are marked a certain way. And those marks are pervasive through all those who hold them. And that ecosystem somewhat exists based on those marks. So I'm not as I said, a doomsday or scenario. I'd say just high level without kind of saying black or white. Higher interest rates, obviously from a discounted cash flow perspective, mean the cash flows that are nearer to you, generally speaking, it tends to go towards the short version, towards value. What I think is really interesting about activism and why I like it is it actually doesn't really matter what the interest rate regime is. The opportunity set is greater, in my opinion, when you have to earn your cost of capital because rational behavior follows through. So certain kind of guideposts and being rewarded for, you know, growing no matter what in models that don't make sense just can't be financed. So that's a positive. But if you think of what the activist investor does and what we do, it's very operationally based. So no matter what the environment, if your earnings multiple is X, and we have the same consultants and industry leaders we work with who can take your margins up by 50%. Whether you have a good multiple or a bad multiple, your stock price is going up because your E has gone up, your earnings. Same with your sales productivity. Capital allocation was probably the low-hanging fruit of the last 20 years, and that's going to be a little more complex, but you're going to need capital allocation. Just, you know, 3% interest rates are, you can live in that environment. It's just a matter of an adjustment. So I'd say from a purely activist standpoint, we do it in any environment. I love the environment we're going in because it's a change. And when people normalize behavior and change creates opportunities. And I always love areas where people are looking the other way. So people have migrated out of SMID cap. They really have. They migrate upwards, whether you're a fund manager because you can aggregate AUM or because the opportunities they thought were larger. So if I look at it in a balanced way, but overall, assuming some type of normalized interest rates that are not zero, you know, it should be a tailwind for value versus the environment we came out of. And the part that is fascinating to me, and again, I think now 290 will get you on the subway, keeps going up, the following, which is, I mean, I was speaking to a family office the other day, and this person believes very much in small cap value and small cap activism. And this individual said to me, you know, it's just so painful. It's, you know, every day we're wrong, and maybe we should just give in and go to those 4 stocks. And that's, you know, I feel for this individual, but it's music to my ears. The moment when the last people are capitulating, when they think everything is great, is typically, there's a reason consensus is called consensus, right? It's usually when things are most interesting. So I think it's a really nice setup. But again, we're somewhat agnostic because the active engagement, if you want to be in SMID cap, there's no reason you wouldn't pick someone like us because we're effectively a great fundamental stock picker with an added insurance policy of driving the outcome that we want.
Ellen, what are your thoughts on activist value?
It's a great concept. I mean, I'm all ears listening to what you work on. I pick managers that I work with that I put my own money in if I had the liquidity. And I like your concept. I like what you do and what you're saying. If there's something that is out of favor, but it looks like it has a future because there are brilliant people behind it that know how to work the system, you know, I'd be all in. So,
you know, I would take a slightly different take, but we look at this a little bit differently because I love the fact that you use the word suggestivist. Mm-hmm. We don't want to be activists because we don't want to get on the committee and lose our liquidity because we are entering through public securities. But we do think there's a queue.
Fantastic. Just so if it's helpful, we actually don't like losing liquidity either. So the way we solve to that, but I'd be interested in your feedback is, look, we're investment folks. We typically have networks and operators we bring on. So if there are committees or board opportunities, we put people in the roles who are experts in them because the sacrifice of liquidity, often, if you look in my opinion, where activism may have gone awry, it's when the activism supersedes the goal of returns. Because if you put right people in the roles, the returns will follow and you want the liquidity to take advantage of them. That's how we think about it, because I'd rather maintain that liquidity.
Right. Because the problem when you go on a committee and then you find out that the CFO has committed fraud, you're in a roach motel.
Cool.
This brings up a very interesting, was there a question from the audience?
I'd like to ask, do I use the microphone?
This is not should not be interpreted as a political question because you're going to adapt your portfolios. That's what I want to find out. How would you adapt your portfolios and actions depending on the policies of a new administration or the current administration? So that you have monetary fiscal policy, you have energy policy, you have environmental policies. All of those policies ultimately attack your method of investing. You have to make a decision there based on that. Otherwise, you're going to lose money. How would you adjust depending on what happens going forward?
Needs the mic back. There you go.
Hey, Mike Swap. I'll answer this for myself, which is, or I'll answer first, happy to. So this, I should start by the stuff we don't invest in. We don't invest in stuff that is single variable determinant. I run a concentrated portfolio. So think of things like high reimbursement risk, things that are pre-revenue or binary outcomes. So I'm a big believer in biotech. It's very hard in a concentrated portfolio to do that because the 0 or 1 kill you. The single variable determinant in certain parts of the energy complex, which are very much determined on the variable. So by the nature of what we invest in, we're somewhat insulated. We are fundamentally driven. A lot of what the regime talks about, my experience has been more perception than reality, but we would be just cognizant of the way they roll through the portfolio, things like tariffs, and we look at longer term secular trends as opposed to near term. Like if you were to look at some of the themes, onshoring versus offshoring, a more anti-globalization, security, all those things are, I think, are longer term trends personally that transcend different administrations, but we tend to look on such an individual basis that really you'd have to fundamentally say the investment structure and market structure is so different to affect consumer businesses, services, or something of that nature. Shy away from things with government as your only customer because the obvious reasons. So we're somewhat insulated in the luxury of being concentrated, but at the same time, I don't pretend to thumb my nose the idea that we don't live in an ecosystem that's connected. So we just have to be aware of them and make sure we understand the risks that we're taking. But generally speaking, as I said, high quality businesses that have predictability of revenue, typically diffuse customer base, and other dynamics that are not directly tied to political outcomes are things we invest in.
Yeah, I mean, I would say very similar. We tend to avoid energy because by the time a deal gets to our desk, it's been picked over by the guys in Houston and Oklahoma City in the club, and they know more than we do. We also don't like the commodity exposure. We tend to avoid financials because the regulators always win, right? That's why I didn't understand the Fannie Mae Freddie Mac trade. It's like you've got Biden as president and it's litigation and it's binary and a hedge fund's going to win. So, we think about it that way. But again, we're looking for good businesses with good management teams that we feel just need to restructure their balance sheets.
And how do you go about finding those companies?
It's, as I said, our two main partners have been doing this for 40 years. We have a network. We have a full-time trader who does nothing but talk to the street. We know all the restructuring attorneys, advisors, consultants. It's just the network you build over your career.
Sure. And when you get in, how do you start your diligence process on the opportunities? And Alex, we'll swing back to you on both of those questions.
I
want you to answer that. I want Alex to follow in. He was going to jump there, and I'd like to hear your response to that first. Suzanne.
Oh, sorry, the sourcing. So we look at it the following way. As I mentioned, we're value/GARP. I mean, how I define that as a path to free cash flow. We need to understand how this business generates free cash flow in the not so distant future. It may be making bad choices. Maybe they've had a problem with working capital or low quality capital expenditures. And then we have a quality bias. And what that means is strong returns on invested capital, a reason to exist, not a perfect business, but a business that you understand and can see that it not only has a reason to exist, it may be an industry in transition, a business going from faster growth to lower growth. So there's okay to have some hair around it, but it has a higher quality bias than not. And then last but not least, from our sourcing perspective is what we call dynamic engagement. And dynamic engagement is what I alluded to at the beginning, which is if you look at the world of activism, there's the behind the scenes, the public, and the moving things in the private markets. So the more ways to win, the better. So an operational plus a strategic plus a governance aspect, the more boxes we can check, the better. From a sourcing perspective, we'd start with the Russell since we do mid-cap. You get rid of about 1,500 companies pretty quickly based on that. At any given time of those 500 companies, there are about 40 to 50 and we're constantly going through that velocity of ideas. We have a proprietary framework that force ranks them and then moves them up and down based upon the opportunity versus their risk, reward, and return profile. And then obviously to add to what Suzanne said, from our perspective, similarly, we have deep networks in the public and private worlds, plus the operators we've known. You never know where a good idea is going to come from. So having your ears open is always valuable. And we do screens and all those things that everybody else does, and then filter it down to 10 to 15 investments.
Great. Would you consider a company in bankruptcy or not?
So not for us. We would not be.
For you,
Maybe
okay.
Post-bankruptcy equity we would do, but in bankruptcy itself is not where we invest. I'm a big believer of do what you say you're going to do well. We want to do mid-cap activism. We are launching this year well. Success begets opportunity. So I think there's some great opportunities in there, but we're going to focus on what we do well.
Very well. Suzanne, did you want to jump in? You seem like you had a comment to make. Maybe I'm misreading your body language there.
No, I was going to just add in terms of what we do in terms of due diligence, that half of the portfolio that I mentioned, that's the small positions. We get in, we get under the covers, we get to know management. Management for us is huge.
Yeah.
And, you know, again, sometimes the bonds go from 70 to par and we're happy. Sometimes we find that it's a melting ice cube and we get out. But we find by having these toehold positions, we learn more than we would if we didn't.
Gotcha. So I guess, Ellen, I want to maybe
Mark,
just...
another question. Sorry, Mark. Hold on.
Sure. Go right on.
They just said, do you use CDS in your
We
portfolios?
don't.
Do you use them?
Can you repeat the question, please?
Do you use CDS in your portfolio was the question from the audience. I believe Suzanne said she did not. We hedge. We don't short for alpha. Generally speaking, we would hedge with a basket of stocks or maybe some various derivatives. It's possible, but not our bread and butter, you know, maybe as some type of portfolio insurance in times of very low vol, given the nature of what we do. We could look at it as a way to express a thesis because you can do that through CDS, but it's not typically, it wouldn't be on my A, B, or C. It may be down there, so I never say never, but it's not generally how we invest. It's possible though. Have to look at the actual scenario.
Could you talk a little bit about when you think it's advisable for a company to go private? Because you mentioned that up front, that was something you look at and consider.
That's a great question, Mark. And I would say, you know, I'm sure I know this audience is quite sophisticated. Companies go private for all sorts of reasons that usually go way beyond their desire to go private. Fund, market condition, what a fund is in its fund cycle, where the management incentives are. But overall, my view is there are certain things that are easier to execute in the private markets than the public markets. So you think of companies that were put together through a series of acquisitions that haven't been integrated. If you're running multiple sales forces or perhaps multiple concurrent systems that don't talk to each other, it is very difficult sometimes to execute that in a quarterly earnings model. So I look at typically deep integrations or business model changes. So if you think historically when a software company went from license to subscription, it took a while for the market to understand that because your GAAP financials were terrible. So as you think of things that really cause dislocation with perception, and as a public company, you know, the management team and the board has to manage the street as well as the business. So I'd say for me, generally speaking, it's when you think the value you can create and the risk to achieving that in the public markets is greater than what you actually think you can execute, then it probably makes sense to consider the private markets. The other thing I would say is capital structures are still very different in the private markets. So the public markets may want a certain aspect, but great businesses with subscription-free cash flows can run levered balance sheets, even at 5% rates. So there are businesses where it's just far more efficient in capital allocation in the private markets still than in the public markets. And then last but not least, depending upon your M&A strategy, there is ample liquidity in the private markets to do so. I mean, the trade-off at the end of the day is lots of shareholders for one, you know, and, you know, in some ways that's good and that's bad. With all that being said, the other last piece I'd say, there's a bit of a long answer, Mark, is most private equity investors are within a fund cycle of 5-ish year hold time. I know what everybody says, but let's let's be real. They want to recycle, get past long-term capital gains and do it. So I always, when someone comes to me, I just think about where that company wants to be in 5 or 6 years, because they'll either be coming back publicly or likely be going to another sponsor. If not, so to think about where they want to be in their arc.
Sure.
So,
I think that was a terrific
Mark, I
answer.
want to jump
Thank
in
you.
here. I want to jump in
John,
here with a question.
go.
So can you guys talk a little bit more about fundamentals? So I like to think of our group as kind of being like a certain vintage group. So like everybody talks about vintages of hedge funds or vintages of venture capital or private equity, but we're like the middle tier. So people do friends and family, they do high net worth, they do RIAs, they come to family offices. After that, they go to institutional, they've been successful with family offices, they move up. So how do you guys assess funds in terms of like capacity, et cetera, et cetera? And do people ever come to you and you say, oh, you're not ready, or you should be looking at those investors or that investors, or maybe you can talk about what that kind of approach, in terms of like what the fundamentals are. You ask, somebody comes to you and you ask your 5 or 10 questions, right?
Me?
Why don't you start, Suzanne, since she sees so many funds, she can also talk about some, and then Alex can talk about his funds capacity, things like that.
I look at when managers come to me and they want me to help them, my reach is really into family offices, and I know them pretty well, and I know the kind of things they'd be interested in. I also look at the investment as to whether I'd be interested, whether my family would be interested, whether I'd be very proud to represent them. As you were mentioning, management is key. Do I like them? Would I trust them? Do I think they're brilliant? It's grassroots for me. It's a gut feeling. Obviously, you got to look at the numbers. And I have to do due diligence personally. I have to do a lot of due diligence. And then it goes to my broker dealer who does even more. So as Mark knows, it's very difficult to bring someone on unless they're blessed several times and seem worthy. And otherwise, I'm wasting my time. I want to collect a nugget that I think, ooh, when I go to this group, they'll say, thank you. This is a fabulous idea. And so I'm very selective.
So, I mean, there used to be like metrics like, pedigree, or they lived out from Goldman or from another fund.
That's important.
Things like that.
That's important to know, what they've done in the past. Having said that, I represented a lawyer came to me and said, hey, I have this group of ladies who have a first-time VC fund. They're young. And I'm thinking, good, but I'm not a magician. And, but I thought I'll be polite and I'll meet with them. And they were brilliant. It turned out that they had done personal investments very successfully. They had huge contacts in Silicon Valley, and they knew how to find little nuggets here that they could call their buddies in Silicon Valley who would co-invest with them. So their funds, started with, they came to me and they said, please help. We got to get over the fence. We want to get to a certain point. And I thought, I don't know. And then I realized, wait a second, I would shout from the rooftops to present them because they're brilliant. They know how to get in there and find little things that ultimately several of them have become unicorns. So you never know. You just never know. I knew they were bright, and I knew they came well represented from a decent attorney, a very good attorney, but I didn't know until I spent time with them. And I personally have had a tough time during the pandemic. I can't do business with people on Zoom, really. I can present something, I can listen to their story, but closing millions of dollars or sharing stories like that just over, the internet doesn't work for me. I want to have lunch with them. I want to have coffee with them. I want to hear about their families and how they operate and where they live and what's important in their life. That's how I work.
Suzanne?
I mean, going back to your question about capacity, I think it's different for different strategies and in different times. We wound down our prior fund in 2012 because we didn't think there was a good opportunity for the asset class. We thought it would come back. We didn't think it would take a decade. But we kept the team together and, sort of became a family office, and we did some venture capital and we did things we wouldn't do with other people's money. You know, people say, what do I think the AUM for our strategy should be? We want to start between 100 and 200 because we think we can put that to work. And then the opportunity set grows over time. There's another manager that I know that got too big and it killed him. And he went from 4 billion to 500 million. And now he's rebuilding. And the performance wasn't that bad, by the way. But he became the market, as you said, and it became harder and harder to manage those assets. So I think you just have to look carefully at what people are investing in to understand what the capacity
I mean,
should be.
becoming the market thing has happened so many times. Long-term capital management. I forget the name
Well,
of it.
that was leverage.
There used to be that credit fund that was on 44th Street next to Grand Central, like Russian guys, $44 billion, right? And they collapsed in 2008 because they gave so much, you know, collateralized debt sort of products, et cetera. I mean, it was terrible. So you hear that one all the time. So maybe I can talk about it a different way, which is that when I look at venture capital, and I got this from like a Ron Conway's partner, right? So like, you know, I was talking to Bob Bozeman, and he was like Silicon Valley Angel, and he said, you know, Marty, everything's vintages. You know, it's like the only reason why we got Google, because they were the first investors in Google, was because we had invested in Yahoo, and Google wanted to be bought by Yahoo when they first started. A bunch of Stanford kids, right? And he says everything's vintage. So he says, if it's 2006 and somebody's talking about nanotechnology, nobody gives a crap about it in 2010, right? And if you think about venture, it really is, you know, vintage driven. It's like 2006, 2007 nanotechnology, 2008, 2009, 2010 social media, 2012, 2013. You can name, you know, sharing economy. 2017 was crypto. You know, 2020 has been a lot of healthcare, stuff like that. And it's all, what vintage are you in? And nobody wants to hear if you're past the vintage age, right? Does that happen in the fund space as well? Right? Somebody's got like a fund strategy and you're like, that was okay 10 years ago. It's not the time for it now. Do you think about that ever?
That's why we shut down our last fund.
Okay, so that's why I'm asking you that question. Can you give some examples, maybe get a little bit more granular? Not on your fund, but about other funds strategies that you see. You're like, I mean, like, you know, like CTAs, for example, they've done okay, but they were great in 2008. Then they crashed for a long time. You know, value, like I had value guys calling me for years, you know, Graham's book, Warren Buffett. I'm like, it's been a dead strategy for 5 or 10 years. Nobody's making it's a bad performer.
Well,
your thoughts?
That's one of the reasons you have a diversified portfolio, right? Okay. I mean, I have this conversation with my late father's widow all the time. She's like, well, that guy's not doing well this year. And I'm like, look how he did last year when other guys didn't do well. So diversification, if it's meaningful, is I think a big part of it. But to your comment about vintages, like private credit scares the hell out of me right now.
Okay. Interesting.
I think it's going to be a good vintage now, but I think the last 4 or 5 years, there's going to be a lot of stuff that.
So Marty, I would just add, so I would separate between two things. The strategies you described are all closed-end funds. And when they have a finite period to invest, a private equity fund, a venture fund, and they all vest on the same things at the same time. Hence, there's comparison among vintages. They're all looking for the same sharing economy deals. It's a bit incestuous, to be direct, as to who gets what. And that really played out when rates were low. So hence the vintage theme. On open-ended funds, so our fund, I'm guessing yours own fund, I'd say it's less vintage and more thematic. And again, a lot depends on your personality and what you like. There are those who believe that the best way to look is where others aren't looking. There are those who believe that the time to invest in a strategy is when it's working well. So they've had different themes, whether it's momentum, whether right now it's multi-strat in the pods. And a lot of it, in my opinion, actually, if you tie it back, has to do with market structure and duration. So I would just leave it on this. Market structure has changed tremendously over the last 20 years in terms of who actually trades the shares and how it's done, from individuals to automated, and then duration. And if you look at where the market has bifurcated, private equity in theory has infinite duration, and pod shops are shorter duration trading with leverage and risk management. What is not really populated is in between the two. And that's where typically you'll find, again, common sense, the greatest alpha opportunities when there's less competition. And generally speaking, now to be clear, you have to make sure you're not crazy, right? I'm not saying like, hey, you know, look at our fund, we're going to invest in the yellow pages because they're making a comeback. But you're looking at areas that have rich opportunities that others aren't looking at because either they've scaled so much, like a pod shop can, or like private credit, they've wrapped everything together. And I completely agree with you that the vintage is fine, but you just can't get those type of returns without risk. So that's how I would suggest thinking about it from a thematic perspective and see what works for you.
And what's your capacity, Alex?
Oh, sorry, capacity. So we look at it just numerically, 1 to 7 billion market cap, say 3 to 4 is the median market cap for a variety of reasons I won't bore you with. You don't go above 9.9% of a public company for a bunch of whole regulatory reasons. 10 to 15 investments put you in the 4 to 7 billion. But to be fair, I want to be best in class returns. So if along the way we realize it's 2 billion, we'll shut there. So that's kind of our
Is there leverage in your strategy?
We don't, well, mildly, but only in the scenario where if we get restricted in something intentionally, like a take private, and it becomes a big cash drag, we would overlay that. Otherwise, you're really, you know, putting yourself at a disadvantage versus the market, but otherwise we don't run with leverage.
Right. And so maybe for Ellen, I can couch this in a different way. Do you look at strategies by the macro environment? Like there's loose credit, therefore value doesn't work. Now it's tightening, or we're in recessionary times, therefore XYZ strategies will work. Like, remember Ron, I don't know, do you remember Ron Suber? Like Ron Suber used to give a presentation all the time. He'd say like, you know, these type of hedge fund strategies, they're not high volume traders. They're not going to get any attention from the banks because there's no money to be made working with them, right? So you have to really think about, from a macro point of view, where they play in terms of promotion, right? So, I mean, you know, so there's actually all kinds of nuances that it's worthwhile to think about. And give me like a nugget of a nuance that you think about that other people wouldn't even consider, but you've been in the business for a couple of years, you know, so maybe.
I'll look at a lot of different things, and a lot of it because somebody comes to me that I respect. And then I want to hear the pitch, but I want to be able to understand the pitch. A lot of people will go into great gyrations of if you take this, and like I can't help you with that because it's too complicated. You know what? So I need to be able to understand it. I need to be able to quickly relay it to someone passionately. Like I believe in it totally and from the heart. And that's the kind of thing that I would work on. I like
but it's also what you help guide them towards, right, Ellen? If you find a fund you think has golden nuggets in it and they're not describing them properly, you help them craft that story and put it together so it makes sense to an investor and why they would want to be interested in that.
Well, a lot of times they'll say, oh, well, this is easy to understand and it's very complicated. I said, you have to give me bullet points now, because a lot of times I'll have a few minutes to say, hey, wait, I got a good idea, da, 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 da. If it's a real complicated strategy, I got to meet with them to boil it down so that people will understand it and not just listen and go, oh. And then, you know, it's...
Everybody drinks out of a cup. If it doesn't fit, they're not going to drink it.
I mean, I tell managers that all the time when I would sit across from managers. I worked at a family office. I was on the investment committee. 25 minutes into a story, if I don't understand what you do, you're doing this wrong.
Right. Or a few minutes. I don't want to listen for 25 minutes and say like, wait a second, did I get this right?
I really think pedigree matters a lot more than people will think. And it's not because people with pedigrees are better, but they just have better networks. It really matters. I mean, in every level, if your strategy changes and you can go out to a network who trusts you, they can trust you enough to keep their money with you for whatever amount of time. Also, the way you interact with managers. If you're a manager who communicates well, that's a big part of the battle if you have downtimes.
That's key. That's absolutely key.
Well,
if they can't present properly and boil it down, take their time when they present, and the one pager is understandable when you look on your phone, because that's how it starts. A lot of people are traveling, they're moving around, and this one pager is just too much dialogue.
Well, and
It's not gonna work.
the other thing I would just add too, for managers, you want to be communicating when the chips are down. You don't call people when you're doing really well.
Over communicate. Yes, you're right. Yes.
I'll never forget in August of 07, Izzy Englander personally called every investor. And he's like, yeah, I called some billionaire on his yacht. He's like, I got problems, but you're not one of them. You're down 80 basis points. And Izzy was like, well, I've never been down 80 basis points. He called every investor personally.
That's so important. You're absolutely right. You know, when it's good, it's great. But when something's slipping and there's a reason and you can explain it without pulling the plug, get there right away.
That's a skills assessment you need to make with every manager you're working with. I mean, I also look for confidence. If I see uncertainty when I ask questions, I'm like, it's a question, so.
Yeah.
Any other questions from the audience?
Hey, Marty, I'd just like to throw in on the pedigree point.
Okay.
In order to get in those schools, you've got to be competitive to a certain degree. And that's why you're betting on these people, is because they've shown that they can compete and get to where they want to get to, that they have that inner drive to make it happen. And that is why, in part why pedigree, along with the others that other people put out there, makes a huge difference.
But I would just add too, pedigree can mean a lot of different things, not necessarily that you went to Harvard.
Right.
My father used to say he'd rather hire a kid who had a hot dog stand on Coney Island in high school because that showed initiative, not necessarily because he went to Harvard. So I think you have to balance that.
There was an individual who had a big influence on me because he was a banker on a transaction. You may know Jimmy Dunn, and he used to, and I'm going to completely plagiarize. Yeah, Samuel, yeah, I'll plagiarize and probably also bastardize this simultaneously. He would say when he was hiring, he looked for refined desperation. And I loved it because he was looking for a person who had a chip on each shoulder, but not in a kind of uninvolved way, but the need to prove him or herself over and over, that internal drive. And that term, refined desperation, I always liked.
I think that was actually Herman Sandler's term.
Was it Herman Sandler? Oh, I heard it from Jimmy. So
well,
I didn't, yeah.
But
it's so reason why alignment's so important, right? It's why you want to see the manager have skin in the game to a significant degree. It's why you want to see everything counting when the chips are down, that, the manager's going to be right there by. And he, to the point that Suzanne made, that's why he's on the phone, right? He's realizing this is a crisis point. I need to show up now for my investors. Marty, thank you so much. Great job by this panel. Really appreciate it.
thank you.